Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 130 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to get back on track. We had our special episode yesterday on the short squeeze and GameStop and AMC, all of that, but we're going to get back on track today and talk about the rules for investing that I think we should all live by. And this is not by any means a long list, and it's not my list. This is Warren Buffett's list of rules for investing. And I just think if you're going to learn from somebody, why not learn from somebody with a long track record of success and learn from somebody who has been at this a long time and really understands what it takes to be an extremely successful investor over the long term. And it's somebody who I look up to and try to emulate as an investor every single day. So that is why I want to take Warren's rules over someone else's. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to those. If you're listening on Apple or Spotify podcast, then make sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and everything I put there is good supplementary materials to all the things that I'm putting out on these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan for yourself and your family, to walk through that plan and stay accountable to the things that you put in that plan, then I can definitely help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So let's just start here. Do you know who Warren Buffett is? I know who Warren Buffett is. Okay, and you may know him as this rich guy, this guy who got rich owning stocks, and that's not wrong, right? It's not wrong that he got rich picking individual stocks. It's not wrong that he did that, but Warren Buffett is just he has his own mind, right? This guy has just really been somebody for this entire generation and even the generation before that has really taught investing to individuals from a very reasonable standpoint where everybody could do it. And he showed everybody that it is not this game of you have to, work on Wall Street in order to be a successful investor. And so what he provides us with are a lot of guidelines, a lot of little one-liners that Warren likes to tell. And, there's things that he says like, when the tide goes out, you'll see who's skinny dipping. So basically talking about people who take, a lot of risk. Or then there's another one that he stole from Dale Carnegie, talking about how the sure thing boat never gets far from shore. So how you have to take some risks and all different types of things that Warren will say over and over and over again. If you listen to his sound bites, then you will hear some of these very famous sayings and many more over and over again. But there's a lot of truth to the things that Warren says, and so I think we can learn a thing or two from them. And so he gives us a couple of investment rules that I really want to break down and talk about, because if there's anybody that you're going to learn from, Warren needs to be the guy. He is somebody who has this immense knowledge of compounding money over time, which we have talked about over and over again on this show. And he has this really deep knowledge of, what it takes to invest for the long term, which is what I want us to be doing. We don't need to get caught up in this, jumping in to help the short squeeze, this Wall Street bet stuff, Bitcoin, buying gold. This is not what we're trying to do. Day trading is not what we're trying to do. No, we are trying to be long-term investors and learn how to do that in a way that is going to be beneficial to us and our families, and hopefully our children and our children's children and our children's children's children right down the line. So let's take some of these investment rules. Again, short list. There's only a few, but they are just integral to being a good investor for the long term. And so the first rule that Buffett has is you should avoid going too far afield when buying stocks. So you should avoid going too far beyond what you know. You shouldn't go just searching for stocks. You shouldn't just go searching for things that you have no understanding of. He says investors should make sure that they fully understand how a business operates, how it makes money, and the future sustainability of the business model and profits before buying a stock. And this would seem like, well, duh, don't you need to know what you own? Doesn't that make a whole lot of sense? Well, of course it does. And this really ties into a lot of things that Warren has talked about over time. He talks about investing a lot like hitting in baseball, like a lot like batting in baseball. And when you're at the plate, right, it's 3 strikes and you're out, right? At the old ball game, it's 3 strikes and you're out. And he talks a lot about how he saw this chart a long time ago, and it had Ted Williams at the plate. And Ted Williams, for those of you who don't know, one of the best hitters in baseball history, still to this day holds the record for the highest batting average in a single season. And Ted Williams was standing there, and there were little dots all through the strike zone, right? Through the zone through which if the ball goes through it, that's a strike, right? There were dots on all different parts of the strike zone, and it just made this big rectangle. And there were 77 dots. Well, within each dot, it said what Ted Williams' batting average would be or was given where that ball would have been thrown. So if you throw the ball at a certain part of the strike zone, he might be hitting 330, but you throw it at another part, he might be hitting 220. And so Ted Williams would have to, from time to time, swing at pitches that maybe he wasn't good at hitting or didn't like very much, just in order to not strike out or maybe not get out at all. He would have to swing at things that were not his favorite. And Warren's analogy here is to investing. And that when you are looking for a stock to invest in, right, you can let as many pitches pass as you want, right? You can let as many opportunities pass as you want. If you didn't get in on Tesla this past year, it's okay. If you didn't get into, GameStop and AMC and all the stuff that's going on right now, then that's okay, right? If you missed those quote unquote opportunities, I don't know how much of an opportunity they were, but if you missed those, those wealth creating events in the stock market, then that's okay. What he's saying is, in baseball, you have 3 strikes and you're out. But in investing, there are no called strikes, meaning, investments can pass you, and you're never hurt by that. You're never punished for the fact that you let an investment opportunity pass. You let an investment opportunity pass. That's something that maybe you didn't understand well, or you didn't, have the full picture of why that would be a good investment, or you had some bias towards thinking something about that company, whatever it may have been. You don't have to swing at every pitch. And Warren's whole idea here is that you can choose to only swing at pitches that you like. And what are pitches that we like? Well, pitches that we like are things that we understand, right? Pitches that we like are things that we can put values on. Pitches that we like are things that we can look at the company's fundamentals. We can look at what's going on within a company and make a good determination on whether it is a good investment or not. And then, and only then, can we take a swing. Because even though there are no called strikes, as Warren says, you can swing and miss, right? But the whole idea is that you do not have to. You don't have to swing and miss when you invest, because you can keep watching things pass. If you have some uncertainty about something, you don't have to swing at it. And the thing is, investment opportunities in stocks, they come back around, right? Just because you didn't like it at a certain valuation doesn't mean you won't like it at another valuation later. If you didn't think it was a good opportunity now because of the management, maybe the management changes later and it's a good opportunity to buy. But this is such a key rule. It's such a key rule to understand what a business does, to understand what they are about, how they make money, what their management is about, how they are going to grow into the future before you ever decide to make an investment decision. And that is what Warren calls his circle of competence. Now, this kind of goes against the idea of diversification because, Warren over time has talked about how you really only need about 6 to 10 good stocks over the long term to make a good career out of stock picking. And he's not a huge, I'm not going to say he's not a huge fan, but his individual stock picking is not the most diversified stock picking. Why is that? Because he is picking stocks that he understands, and that is within his circle of competence. So a lot of those companies can fall into similar industries. They can make money in similar ways. But obviously he understands diversification and obviously runs a conglomerate of a company in Berkshire Hathaway that is constantly acquiring new companies and diversifying their portfolio even further. So there's that as well. But he's saying for an individual, maybe diversification is not that big a thing when you're picking individual stocks. Stay within your circle of competence and you will be best served over the long term. So I think that is a great first rule to follow. And it's really intuitive. All of these are really intuitive. But if you really think about it, it really brings you back down to earth as an investor. This first rule does. It brings you back down to saying, okay, I don't need to worry about all these things going on where huge returns are happening and I'm not a part of it. And I don't need to get this fear of missing out, this FOMO, right? I don't need to fall into that place. I need to, control what I can control, understand what I can understand, do the work, realize that if I'm going to buy individual stocks, which not everybody should buy individual stocks, if I buy individual stocks, I need to do the homework. I need to understand what the company does. And then and only then should I go about making a purchase. And this extends even to fund investing, right? If you're buying index funds, mutual funds, whatever it is, you need to understand whatever you invest in. It doesn't just have to be an individual stock. You have to understand what a mutual fund does. You have to understand what an index fund does. Because if not, and I've talked about this before, is that we can get afraid. Our risk aversion, right, can seem a lot higher just based on us not understanding something. A lot of times if we just understand what we're going into, then our ability to take on the risk inherent to whatever that is will be much higher because we're like, oh, well, I know what this is. I know what this does. I'm not worried about this amount of volatility it has, because typically if you don't understand something and it starts to go down in value, that can really, get the chest tight and make it hard to breathe and like, oh man, I don't know if that's a good, and that's when you see a lot of people trade in the short term. It's not what we're trying to do. Understand what you're going to invest in and you will be best served. Then a second rule that Warren Buffett has for investing is to remember that you are buying a business, right? When you are buying a stock, you are buying a business. And where does he get this idea from, this crazy idea? Well, this book that we have talked about previously, The Intelligent Investor, written by Ben Graham in 1949. And during the 2002 Berkshire Hathaway annual meeting, Buffett said, "You're not looking at things that wiggle up and down on charts or that people send you little missives on. Saying buy this because it's going to go up next week or it's going to split or the dividend's going to get increased or whatever. But what you are trying to do is you are trying to buy a business." And so you should not have this idea when you're investing of, this is going to do this in the next week, so I need to jump in, or it's going to do this, so I need to jump in. This kind of goes back to everything I was talking about with AMC and GameStop and things like that. We don't need to just jump into trends. We need to buy things because we are purchasing the business. And most people, if they understood the businesses of things like GameStop, AMC, might not be so interested in jumping into that type of trade. And so what Buffett is saying here, and what he gets from Graham's book, is that buying stocks makes you a part owner of a business, right? So you're someone who should not be concerned about the short-term fluctuation in stock prices. And this goes to an idea that we've talked about previously called Mr. Market, right? Mr. Market is talked about in The Intelligent Investor. And what is Mr. Market? Mr. Market is somebody who comes and knocks on your door every day and offers you a price at which you can buy or sell stocks, right? And Mr. Market is offering you this price at which you can buy or sell. And some days the price is attractive. Some days the price is fair. Some days the price is unattractive. And this should help to make our decisions as to what we buy and what we don't buy. But if I own the business, right? If I own a piece of the business, I should not care what the stock price is tomorrow. I should not care what the stock price is next week. I should not care. I should care that the business continues to grow its revenues, that the business continues to grow its earnings, that the business continues to grow its cash flow, that the business is, returning capital to shareholders in some way. I should care about the health of the business. I should care that the business is not going into too much debt. I should care about all of these things. I should care that they're in a good financial position. And that will better ensure future returns for me than trying to just pick up on some short-term blip in the stock market that might make me a quick buck. Because again, we're not out here trying to make quick bucks. We are long-term investors. And so you have to remember that you're buying a business, because at the end of the day, what is a share of stock, right? If you're asking what a share of stock is, all it is a piece of a company. And shareholders are known as what's called residual owners of the company. And what does residual owners mean? It means that after the creditors are paid, and even preferred shareholders, but we won't really get into that. But after those creditors are paid, and after we have paid all our bills, and there's a net income, there's a bottom line, the investors have the right. That bottom line is attributable to the common shareholders of the firm, to the owners of the firm. Now, it obviously doesn't get given right back to them. They don't just get the net income paid out to them, but they can in the form of dividends. But that net income can also be reinvested into their retained earnings and reinvested into the business, where the business can grow at a higher clip moving forward. So that would also increase the value for the shareholders. And so if you are buying a business, that's what you care about. If you're buying a business, that's what you want to look for. You want to look for a company that is going to grow your wealth over time, and that is just going to grow in and of itself over time, and not care about the short-term blips in the stock market. There's just too much going on there that is going to force you into making irrational decisions that should not be made in the short term. When it comes down to it, the stock market just has a whole lot of noise. There are people talking on TV every day. There are people that are at your job or at your school or whatever that are talking about stock tips and things that you need to buy every day. And there's just a whole lot of noise. And the truth of the matter is that the noise doesn't matter. What matters is the fundamentals of the businesses, the fundamentals of the companies, the economic outlook. Those are things that matter. If you don't keep the fundamentals at the forefront, then you can be tied down into this idea of short-term profit taking that is really not that profitable over the long term at all. So you must remember that you're buying a business. You must remember that what you own is a piece of a company, not just a stock. For some reason, we think of these stocks as fairy dust, as nothing, as something that doesn't make a lot of sense and doesn't matter. And it's just this thing that electronically I own, and it's a game, and we can gamble, we can jump in, jump out, and do all these things. But what you fail to realize is that when you buy a stock, you're buying a business, you're buying a piece. So treat it as such. If you were actually going to buy a business, if you were actually going to buy a company, wouldn't you do a lot of due diligence on that company? Wouldn't you pay attention to that company's financials? Wouldn't you see how that company was run? Wouldn't you, try to make sure that everything pointed in the direction of you investing in that company, making you more money in the future? Of course you would. And the fact that you would do that means that when you purchase a stock, especially a stock that you are going to hold for the long term, a stock that you're going to invest in and not just speculate in, then you should be doing the same things. You should be doing the same type of due diligence that you would do if you were just buying the entire business. Because buying a piece and buying the entire thing is really not all that different other than liability, but your returns are going to come from the same place. So that's where your attention should be held. You are buying a business. You are not buying a lottery ticket. So we've talked about staying in your circle of competence. We've talked about making sure that you remember that you are buying a business, not just this fairy dust piece of a stock. But that is going to lead us into this third idea, this third rule that Warren has for us. And that rule is buy stocks that have a large enough margin of safety. And we've talked about margin of safety multiple times on this show, and we'll rehash it for a moment here. But again, this is another idea that he takes from Ben Graham and The Intelligent Investor, this idea of the margin of safety. And what is this idea? Well, what it is, okay, I'm going to invest in something. I need to know what that thing is worth. Okay, I need to put some what they call intrinsic value on this company. I need to look at the fundamentals. I need to determine what the value of this company. I need to determine what the value of this company is today. Once I make that determination, then I can compare the value of the company today with the price at which Mr. Market, the market, is offering me for that particular company on that particular day. And if you look at those two things, obviously, if the current market price is below what you think the intrinsic value is, then obviously you have upward value that is showing up in the stock. It's showing up in the fundamentals, that there's value to be had. But what Warren is preaching here is that you need to give yourself enough room between the current stock price and the intrinsic value that you are putting on one share of the company's stock in order to not make a mistake and end up cutting your returns down or not making any returns at all, because slight mix-ups in your valuation or little things changing as the company changes over time can obviously change where the stock price should go. And so if you don't leave enough room for that margin of safety, then you can be in trouble. And so what this does, this approach to buying bargain companies, right, buying value companies, it limits your potential losses in case you estimate your intrinsic value is too high, or if unforeseen events damage a company's prospects, like I just alluded to. Now, of course, coming up with an accurate estimate of intrinsic value is not easily reduced to formulas, but the Graham method, as employed by Buffett, rests on vigorous fundamental analysis, right? Vigorous fundamental analysis, looking at the fundamentals of the company, looking at the earnings, the cash flows, all these things. And so they look at this fundamental analysis of data pertinent to the company, its industry, and the general economy. And what makes Buffett stand out is his decades-long ability to make astute adjustments of value, because obviously valuing a company today is far different than valuing a company 50 years ago, but Warren has continued to do it well. And if we are going to pick individual stocks, we have to do so as well. We have to be able to put some value on a particular company. Now, we've talked about value and growth investing. Obviously, Warren is a value investor through and through. Now, this doesn't mean that this particular rule doesn't fall in line with a growth strategy as well. The difference, though, is with a growth strategy, obviously we are expecting some amount of future growth, and we need to have some basis by which we expect future growth. And if we can determine what those expectations of future growth will be, then we can put a margin of safety between whatever the price of the stock is selling for and what you expect it to be selling for in the future. Now, this is obviously a value investing tenet, right? And it's something that you need to make sure you're doing if you are trying to go out and buy companies that are selling for cheap, but companies that are selling at a premium to their current metrics, a premium to their current earnings and cash flows and all of those types of things. That can be more difficult, obviously, to find a margin of safety. But what you have to do, instead of just looking at current earnings or current cash flows or current sales, you have to look at into the future. What are the sales going to be? What are the earnings going to be? Cash flows? What are we expecting them to be? And then determine based on that, okay, then what should the shares sell for in the future? Find the margin of safety and see if it is available in the market based on the market price today. And then you can make your investing decision that way. So having the margin of safety, having this buffer between you and your ability to make long-term returns is extremely important. And that's what Buffett says you should do. So I think, hey, why not go with what Buffett says? And then something that I think we could all benefit from, and this is not necessarily a rule that he gives, but it's something that he preaches time and time and time again, is to never look at a headline, okay? And that doesn't mean when you're investing in individual stocks that you shouldn't keep up with the news of that particular stock or the news on the company or things like that, because obviously that is material information to the homework that you're going to do on the company. But he says that for the average investor who lacks analytical prowess, right, or sharp eye for stocks, things like that, he believes that just casting your lot with long-term prospects for the United States economy and the U.S. stock market may be the safest bet. So what's he saying? Buy the S&P 500. If nothing else, if all else fails, go buy an index fund of U.S. stocks. That's what he's saying, right? He's saying a large diversified group of U.S. stocks over time is going to be a beneficial thing. And in that case, you don't have to look at a headline. In that case, you can just systematically invest. And this is something we should all be doing. Again, if you do pick individual stocks, I've said this before, I'll say it again. If you do pick individual stocks, that should just be a piece a smaller piece of your portfolio. The large piece of your portfolio should be in your IRAs, your 401ks, in index funds, mutual funds, things of the like, growing in a far more passive manner than what we are investing in when we buy individual stocks. But he's saying some people just don't need to buy individual stocks, and you can buy a large cross-section of U.S. companies and do perfectly fine over time. And I think that is some of the best advice he can give, especially to the normal investor, the normal individual that's not going to dig into the fundamentals, that's not going to do their homework, and shouldn't have anything to do with individual stocks. You can still buy the market, and over the long term, that will be your best bet. Now, he said, and I quote, "The best single thing you could have done on March 11th, 1942, the day that he bought his first stock, was buy a stock index fund and never look at a headline, as if you bought a farm," right? Because if you buy a farm, and he talks all the time about farms and apartment houses, right? If you buy a farm or an apartment house, you're not just going to every day go look for a price for the farm or the apartment house, because it's far too inefficient of a market, right? The market is not near as liquid. And he talks a lot about, just because you have liquidity doesn't mean you need to use it. Meaning, just because you have the ability to buy and sell quickly doesn't mean that you need to use it. That's not what's creating long-term value. So he's saying if he would have bought a stock index on that day and made a $10,000 investment as if he would have bought a farm and never looked at a headline again, right? Then that fund, that $10,000 investment would be worth over $50 million today with reinvested dividends. That is so, so powerful. And for those of you out there right now who think like, hey, I can't do what Warren Buffett does. I can't do the homework. I don't understand fundamentals of companies. I don't get it. He just told you all you have to do is go out and put $10,000 in an index fund, and you wait several decades. Obviously, you have patience, and millions of dollars will come from that $10,000 original investment. It just will. Due to the compounding of money, the growth of the United States economy over time, it is a good bet to make. It is a good thing to be investing your money in. And that's why, even though I do talk about these specific strategies of investing, I talk about buying individual stocks, I talk about all these things, I think it is still very relevant to understand that even one of the best investors that there ever was to walk the earth, even he says that one of the best things you can do is to buy stock index funds and never look at a headline. So if you are not somebody who thinks that you could succeed in individual stocks, or you don't have the time to do the homework, or you don't want to really get into that, you're not really interested, buy stock index funds and you will succeed over time. If the Oracle says it, I'm going to go with it because he has succeeded for so long. Right? I really think we should look a lot more at history when we're talking about investing. We need to look at people who have done it before and people who have won at this game that we are all trying to play. And we are all trying to build long-term wealth. And a guy like Warren Buffett, listening to his rules, his principles can help you to do that. And hopefully these rules that we've talked about today can do you some good. As simple as they are, now, if you do all of these things, you will be a successful investor. If you stay within your circle of competence, right? If you remember that when you're buying a stock, you're buying a business. If you keep a margin of safety in mind when you are buying individual stocks. And if you don't want to buy individual stocks, if you just buy stock index funds and never look at a headline, you can be a successful investor if you follow those principles. So I would say, hey, all of those things, even though it's a short list, it's a very deep list, and if we could stick to those principles, we would all be far better off in our long-term ability to build wealth. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to get back to you if you leave something down there. Follow me on social media at MNO with Dylan, and that's good supplemental materials to all the things that I'm putting out on the long-form YouTube and podcast episodes every single day. If you're listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review on either one of those platforms. And if you need somebody to help you to create a financial plan that would work for you and your family and keep you accountable to that plan over the long term, then I can help you do that. Go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in Monday as I talk about procrastinating with your finances. and how that can leave you looking back and going, what if? And so we don't want to be procrastinators. We want to be very intentional with our money and with our ability to put ourselves in the best financial position possible. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.